The plan this afternoon is that we are going to have a roundtable discussion on data in the commodities market. That means how we source it, how we guarantee quality, and ultimately how we build trustworthy data sets that our clients can confidently trade on. My name's Neil Crosby, Head of Analytics here at Sparta, and today I'll once again be your host. Now, joining me are three expert speakers who bring a wealth of experience and market knowledge. Firstly, we have Victor. Victor leads the Energy and Commodities Product Division at Parameta Solutions, leveraging over a decade of experience in energy markets. Prior to this role, he served as Head of Power Solutions at Wood Mackenzie and as a trader at Vattenfall on the cross-commodity desk. Victor, hello.
Hi, everyone.
We also have Stephanie. She's our CSO at Sparta. Stephanie has over 20 years of experience in commodities and is passionate about the creation of innovative services and new technologies. She was the CEO of ICE UK in the 2000s, and she also had roles at Man Financial and VACT. Hi, Stephanie.
Hi, Neil. Thank you for inviting me.
Always a pleasure. Lastly, we have Moody. He's our product manager of data, analytics, and intelligence at Sparta, and also brings a decade of expertise in quantitative trading. He worked previously at Refinitiv in Geneva and ran the energy quant desk at Geneva Trading in Dublin. Hello to you, Moody.
Neil, lovely to be here.
Now, before we dive into today's discussion, just for those unfamiliar with us, Sparta delivers real-time, forward-looking market intelligence designed by traders for traders. Unlike traditional data analytics providers, we focus on actionable insights that help traders identify and capitalize on market inefficiencies, bridging the gap between price and value. With Sparta, you always trade with conviction. We have solutions already essentially across the oil barrel. So we have offerings for gasoline, naphtha, distillates, crude, freight, and now also fuel oil, with more to come on the gas side this winter. That gives our clients a comprehensive cross-desk solution for actionable insights and intelligence. That means our clients get access to real-time forward-looking prices at their fingertips with no setup hassles or delays. It's all accessible via the web, of course, but also with our Excel plugin and our iOS mobile app. With us, you can automate your workflow with clean, forward-looking pricing from over 30 leading providers and brokers across the oil market. And we're providing a free 45-day trial to Sparta Curves for a limited time. To see the power of real-time oil market pricing for yourself, contact us at sales@spartacommodities.com or book a demo with us today. Now, without further ado, let's get stuck into our discussion today. So why don't we start with some questions for you, Victor, as our special guest. The first one is, how difficult is it for you to get good, clean, real-time data internally, and what's your process here?
Yes, very good question. Pleasure to be here, and thank you for the invitation. So I'll be speaking today on behalf of Parameta Solutions, who is the data arm of the TP ICAP group, which owns the TP ICAP and PVM brokerage brands altogether. So on the data side of the business, we do face challenges in order to collect clean and reliable real-time oil data. The main challenges we face are threefold. So I'd say that the first one is technology. So we need to integrate different systems together. That is, various data sources held in different databases and with different formats that require sophisticated and different middleware, all scattered around the group. So we need to integrate all of these different systems together. So from the data ingestion, that is really what type of real estate we push on the screens of the brokers, so really the ones that generate the business and generate the data, all the way to the data distribution, which is really where do we surface the data and how do we surface this data. We can surface it via vendors, we can surface it directly to clients. We have recently built an in-house app called Fusion Insight that allows us to surface our prices directly to customers as well. So when we apprehend a new problem or tackle a new challenge like this, we have three options to roll out technology. We can either buy it, build it, or partner. In that very instance, we looked at different partnership solutions and options, and ultimately we decided to go for an in-house solution that we built. The second main challenge that we face is really straightforward and related to costs. When you build something in-house, you have infrastructure investments and you have operational expenses. There's a significant upfront cost to build the software, get the dev team aligned, and actually build the processes, host it on the cloud service, set up the connectivity. You also have ongoing costs with infrastructure maintenance, data storage, and very importantly, security. Again, when building our recent app, Fusion Insights, that allows us to surface prices in real-time oil prices, we really had to tackle those challenges head on. And lastly, if not the most important one, is some sort of control mechanisms. So in order to build a partnership with the brokerage and with our clients, we need to establish a clear line of communication, a clear line of trust. And in order to do that, the brokers need to have access to some sort of control as to who sees their data. We're talking real-time information. So they want to keep some level of control as to who gets to see it. On top of it, there's a real issue of data quality. So it's real-time data going out to clients that is entering the real world and directly executable. So we need to make sure that this data is timely, complete, and secure.
Very good, and thanks for that. And just in terms of, you're talking about control mechanisms and data quality, essentially, what control mechanisms do you actually have on your data? I mean, there's things like inhibitors lists. Can you just say a bit about that?
Yeah. So as I just said before, so for a broker, the price information in essence is sort of their intellectual property. Having the good price allows them to capture more market shares, right? To have more flows. So in the case of oil, for instance, it's still 70% OTC, over the counter traded, as opposed to exchange traded. So the brokers really do have an edge here. They really have to balance between having the and more volumes, but at the same time, they want to go against some potential leakage of their price information, especially to competitors, as an example. So we always strive to achieve accuracy, speed of delivery, and maintain that control. However, it doesn't always go as planned. We have a very dedicated data quality team that works across the clock from Singapore to London and New York. And for instance, at the beginning of April, when Trump started the trade war and to roll out different tariffs everywhere, it had a negative impact on the market across the board. And what we saw is that the markets opened down by 5 to 10%. As a result, correlated markets, the oil market was also down up to 10% in some areas. Obviously, this triggered all sorts of alarms across the board in our systems, red flags, and basically erroneous data was flagged. However, the data quality team really had to take actions, and they really had to assess, okay, is this really is it a real outlier? Is the real flawed or flagged wrong market prices, or is it actually correct, and does it follow more general market trends? And that really brings in the critical question of, in data quality and data management, how do you identify an outlier in times of regime change? How do you handle missing data? Do you hold the wrong price, or do you put it out there at the cost of losing on the real timeness? So these are really critical questions that we have to address.
That's excellent. I mean, maybe it's a very good time to get Moody, your thoughts on this topic. What Sparta's experience with cleaning data, for example?
To be honest, it's actually very refreshing to hear Victor's sort of challenges. We definitely echo the same. We see the same challenges. At the end of the day, we're all looking at very similar data sets. But to be very frank with you, once upon a time, Sparta had no cleaning algorithms. Our co-founder, Miles, understood the challenges that having sort of dirty data was having on our platform. So we dedicated, like Victor and his team at Parameta, a whole team for just data cleaning and setting out sort of automated alarms and filters in place. Um, we not only what we see at Parametra, but for other providers, we have over 30 different providers in terms of brokers. The data that we receive, it's more or less raw, unstructured, as well as fed in through an API. However, having all of these sort of different data sets coming in real time, there needs to be somewhat of a robust system in place so that we could feed that or pass that through to our clients. So our experience has been sort of a constant effort over the last 2 years. And what Victor highlighted as well, what you've sort of seen in the regime shift, I think it's sort of a really good point or observation in that has your systems or robust systems been working in place correctly so that it could sort of counter for these regime changes in the data. You don't want to just come in the morning and then all systems go loose, but at the same time, it's a really excellent way to understand, are your systems in place that are robust. Um, I think that's where we are really with our cleaning sort of systems. But I also want to reflect on the point that Victor made about 2 or 3 weeks ago when Trump's tariff news hit. It was really interesting to see. We have access to a few different providers for the same curves, and what I wanted to highlight was essentially the human effort or the human side on the brokers. We saw large discrepancy in prices. Our alarms, yes, they were going crazy. But what we saw was, like what Victor mentioned, about 70% of the oil market is still tradable OTC. It's not like the futures where it's instant access and the market corrects instantly. We saw deviations for more than 20, 30 minutes across different providers. So the human element of the broker still exists. And it's quite actually nice to see that it's not essentially the data is wrong. It's just that the brokers are busy. They have other things to do than update prices. They want to do their business. So there is maybe a conflict of interest in that. They're putting their interests first, but at the end of the day, the market is traded OTC.
Yeah. How did we overcome some of these challenges? Can you talk to us a bit about what we've done at Sparta to do this?
Absolutely. So perhaps like really every provider, every curve, every data point, it's different. So perhaps what I can do is actually share some slides and show you some real sort of examples that we've done to overcome this. I'm just going to step over here now. So what did we do? So we generated some synthetic data sets that resemble real financial time series using Brownian, a generic Brownian motion. And what we wanted to understand what was real in terms of outliers and what was not real. So here's an example of a simple time series that we've sort of added outliers to. And essentially, when we're doing our sort of our testing or for outliers using different algorithms, we wanted to correctly identify what are outliers and what are not outliers. And in order to do that, we have to place those outliers. And we cannot just run it on time series and really just best guess. So essentially, what you're seeing on the screen here is just an example of how outliers could look throughout the data. So essentially, if a provider mispoints a number or we receive a wrong number, we need to correctly identify if these are incorrect. So this is a sample of just an additive sort of outlier. Here, next is much more difficult to understand in our algorithms in that it's a level shift. It's when we receive data that is wrong, and then it continues to update in this wrong area. So these algorithms need to understand the history of these prices so that if a level shift does occur, it simply holds it or puts it in a purgatory area before releasing it again. And this is one of the more difficult examples in our cleaning algorithms to detect, but we've got to a stage now where we can detect these over the years. And then on the point of volatility, where the regime change is essentially like what happened 3 weeks ago. We completely do not want to hide data. We want that data to pass through. It's real, it's accurate, the market has changed. So again, our algorithms need to understand this and that it's just a new change in where the data is. And then lastly, if you sort of add the different sort of problems that we have mixed liquidity in terms of that the data might be illiquid, but also there's outliers, but with that there's level shifts. So imagine combining all of these problems into one, which is probably the most difficult. We need to sort of maximize a metric, and those that are quants and analysts will understand there's an F1 metric, which sort of maximizes for precision and accuracy, and essentially that's what we've done historically with our data sets. Now we couldn't apply that on our live sort of algorithms because it looks historically. So we have different algorithms in cleaning for historical and live, but essentially in the end result then, we have sort of different algorithms being tested on our historical and live. And we found that there was one called the Kalman filter that was proven successful over all of these different sort of time series with different outliers, different level shifts, different liquidity, illiquidity, and so on. And how did Sparta sort of overcome these challenges? Again, I want to reiterate, it was a constant effort. It was understanding the problems as they come. So many months ago, even a year ago, we saw different regime changes and we adapted to that. So then we adapted our sort of cleaning algorithms to understand how the market shifts. So essentially, we have sort of constant work being applied on our cleaning algorithms just to ensure that the data is real time and it's accurate.
Oh, yeah, that's a bit of a headache. Stephanie, maybe it's a good time to bring you into the conversation here. So just to pick up on basically what Moody was saying, why has Sparta spent so much time and money in doing this at all, in data cleaning? And related to that, how do you see the role of data providers in the current trading environment?
Yeah, so as you said, Neil, and Moody said the same, Sparta, we work with 30 plus different data sources that provide us, tens, hundreds of thousands of data points every day. And so we needed to first automate the ingestion of this data to make the process more efficient. And the second thing was to basically clean the data. And why? To answer your question, the first reason is we have two key reasons. The first one is because Sparta relies on this data to perform its own calculation and analysis. So in a way, we are our first customer. And the second reason is our customers depend on this accuracy of the data to make informed trading decisions using our own system. So these were the reasons why we had to spend this time and money in data cleaning. And we did also spend a lot of time and money in data ingestion. Because as Moody was saying, we receive the data in different format, different structure. We receive some data by email, by Word, by Excel. So it's a big work. And now related to the data providers, what the role of a data provider is in this market is critical in my view, because if you look at the new technologies such as satellite or drone or IoT, they now allow the market participant to get access to a lot of data. On top of that, you have a greater computing power accessible to the market participants as well. So the environment is like very good for market participants to start and play with more data. Now, the complexity is, as we mentioned before with Victor and Moody, is how you ingest and how you clean the data. So it is where I would say that the data provider are crucial in this market in navigating this complexity, basically, and allowing the market participants to use the data to make their own decisions on the trading side, but also you can see the value of these data being clean and accurate in risk management or in market makings, your book, etc. So it's at different levels within trading companies that having clean, real-time and accurate data is super important. So that's where I think that the data providers are key.
Thanks, Stephanie. I mean, just to maybe change tack a little bit, but what about financial markets here? So are they different to commodities, and are they pushing commodities to get more digitalized? Can you say a bit towards that?
Yeah, I would say they are different. They are more advanced in a way. So yes, I do think that the financial markets are pushing commodities to get digitalized. They are not the only thing pushing the market to get more digitalized. You have also the new technologies, as I've mentioned before, giving more data accessible. And also, I think the third thing is I think that trading companies are looking for more efficiencies in their trading process and support. So I think these are the three main reasons. Financial markets definitely is leading the oil market to get more digitalized. And in fact, you could think about the IPE, early 2000. The IPE was a global exchange where futures contracts were traded were transacted on the trading floor, and it was like a global. It was not a global exchange; it was a regional exchange, and they were representing less than 25% of the global oil futures market share. And at the same time, you had the London International Financial Futures and Option Exchange, LIFE, that was embracing the internet technology. And their activity on the market was changing a lot. And that's when IPE was not thinking, perhaps we should evolve from floor trading to electronic trading. And that's what they did in 2005. And you could see that you had more financial institutions like the CTAs or the hedge funds participating in the oil futures market. They were very keen on investing in this market, which was bringing them much more volatility. And now you can basically say probably that ICE is representing, about 50% of the global oil futures activity. So we've seen that previously in the early 2000s, that already the oil market was, getting pushed to get more digitalized by the new technology, being the internet at the time, and by the financial markets. So it's not new.
Victor, maybe back to you. Do you see any differences between financial and commodities just in this context?
Yeah. I really felt like reacting to Stephanie's points, because I definitely agree. Historically, to Stephanie's point, right, commodities has always been a bit lagging against equities and bonds and other asset classes, especially in terms of technological development. And we see that it's changing. There are many reasons. There are a few reasons behind, but basically, if you look at the early days, oil trading really began with physical exchanges. You had bilateral agreements, often influenced by geopolitical events or monopolies or different types of drivers, but ultimately you had physical barrels being exchanged between two parties. Then later on, 70s, 80s, you then had spot trading, futures trading, and this was really a first milestone allowing for more standardized and transparent pricing. So when we talk about the digitization of the oil data and the oil trading, we mainly focus here on the financial part, the paper market, not on the physical one. And when you look at the paper market for oil trading and the need for oil data and the way it's being traded nowadays, you do see both similarities, but still some differences that give it a reason why it's lagging. So on the similarities, you can see the rise of algorithmic trading, AI as well. So all these different models that are run by hedge funds, by banks, by one-man shop, literally by nearly everyone nowadays, there's an increasing need for a feed of data. Really similar to any other asset classes, oil models need that real-time information to trigger, to feed the indicators and trigger some trading signals. And that ultimately can help optimize all types of strategies. We're talking proprietary trading strategies, but also hedging strategies. So really based on different use cases that each client have. Also very modern, since Trump joined, but it comes and goes. Volatility on the market. We see increased volatility, and that ultimately leads you again to an increasing need for data, accurate data, complete data, timely data, to make sure that you can assess your risk in real time, to make sure that you get the right trading signal to be in the market, and that you can manage your portfolio more effectively. Then that was for the similarities, right? But then on the differences, we still have also fundamentally a difference in market structure. I explained the physical underlying in the beginning, and then moving on to spot and futures. So ultimately, even the futures contracts or the forward contracts, they all have a physical underlying, right? And the complexity in oil trading that has complex supply chain, varying quality standards of oil, and still the presence of some bilateral agreements really create a sort of different structure that gives OTC and brokers an edge, and that preempts exchange to fully standardize the market.
What about you, Stephanie? Do you think oil is reluctant to change even?
I think human beings, generally speaking, are reluctant to change, but yes, I do think so. Yes and no. So yes, in a way that the way people have been working so far in your market has been quite profitable. So why do you want to change something which is profitable? That's the first thing. Second thing is, as Victor was saying, having an opaque market, not so transparent, was good for a portion of the market participants. So they are kind of I think that over the last few years they have evolved, but to start with, they were quite not very happy with the market being more transparent. But I really think that that's it. We are in the train, and the changes are happening, and you have new generation like Victor and Moody, more like the quant traders who are. It's all about data, and I think that they're going to push the market to change, as well as I mentioned before, the trading companies are looking for more and more efficiency, and automation, digitalization bringing this efficiency. So I think that the oil market used to be a lot more reluctant than it is today. I would say they are starting to embrace these new technologies and these changes. I think the complexity for them is more: am I the first one to jump on the train, or am I going to be the 10th one to jump on the train?
We'll find out in the fullness of time, I suppose. Maybe one last one for Moody, if you can, and then we'll move to our Q&A. Do you think sometime in the near future, can you see a future where a fully automated data sourcing, ingestion, and cleaning process can exist without any human intervention?
Short answer, yes. Perhaps most likely a hybrid approach. The data sourcing already is sort of becoming automated. You have platforms out there that are sort of aggregating all the different data sources into one sort of shop where you could just essentially like check out the data. So that's sort of being automated. However, on the ingestion, for those that are essentially not tech savvy with the data, it's becoming much, much easier. You can simply get an LLM to really communicate with you and the API and how to actually ingest the data. But what I would say on the data cleaning, you could probably automate 95 to 98% of that using the current technology we have right now. However, there's still a human aspect you need. You would still need that hybrid approach, in that if something happened like the regime shift, or if there's something moving the markets, algos may still consider those as outliers and really sort of set them aside, whereas the human approach will understand the dynamics, what's moving the markets, and so on. So I think, yes, you could have a fully automated in some way, but will it be as reliable and accurate as sort of a human? No. But definitely the future, or the way it should be, would be more or less a hybrid approach, in that you have alarms in places for static data, feeds dropping, outliers, and so on. And then the last touch is essentially the human element, where they could sort of pass it on, or sort of leave it alone and say, yeah, these algorithms are doing a great job. Essentially, the algorithms are there to basically save time and make your sort of job much more efficient.
Yeah, and if
we'll
I can
see.
add
Okay.
something, to Moody's point, is it's interesting because when we look at speak with financial players, more like the hedge funds and especially systematic trading fund, they usually request 5 to 10 years of historical data. And but recently, if you look at and why the 5 to 10 years is because they want to have at least 3 big stress scenarios that they can work through. And if you look at the last 3 years, they had more than 3 of these stress scenarios. And so now they're waiting for a calmer kind of period to be able to really train their algorithm, because when it's too volatile, too hectic, the algorithm doesn't it doesn't understand exactly what Moody was saying. It doesn't understand, okay, what is right, what is wrong, what is, an outlier, what is not. And I think that's where, you still need human being in a way. So I basically second what Moody was saying just before.
Very good. Well, thank you very much, guys. With that, why don't we move on to our Q&A round? I believe we have some questions posed by some attendees over the last few minutes. Let's see if I can get these to work. Speaking of humans and digital worlds, the first one goes for you, Moody. How much latency do the cleaning curves algorithms cause to the real-time delivery of data?
That's a very technical question, which is great. Well, maybe if I give a little story, when I was trading as a quant back in time, like every millisecond sort of mattered, even to the event that like you need your strategies close to the exchanges, like co-location. So perhaps if you're not trading high frequency, and you're in the oil markets and everything's OTC, milliseconds won't really matter. But essentially, if you want the real answer, it's between like 100 and 300 milliseconds. So really, nothing for the average oil trader to have an effect if you're not having a high frequency trading system. So essentially, really, if you're behind the screen looking at updates on our platform or elsewhere, you wouldn't even notice the real-time algos sort of kicking in. But essentially, you need them. They're going to be much faster than any human, so really little to no effect.
Very good. Next one, I guess, goes to you, Victor. We've had a couple on the same type of topic. See if I can get this one up. We've been speaking about how OTC represents a significant portion of the oil market. Do you see the oil swaps market going hybrid or fully electronic in the next 5 years?
Oh, this is a good question. So maybe I can provide pieces of information. I mean, I think there's going to be drivers and bottlenecks driving the full digitization of the oil swaps market. AI, cloud computing, advanced technologies, these are big data analytics. These are all strong drivers of the digitalization of oil. You also see regulatory compliance, regulatory requirements that push companies to adopt digital solutions because it allows them to have more transparency and streamline the processes. So that will definitely push towards a full digitalization. I still think we will stick to a hybrid model in oil for a bit. There's a transition phase. There are some contracts that are not easily standardizable. There's this resistance to change, because the brokers have an edge here and they can still capture most of the profits to themselves. Cybersecurity risk is another one. And integration challenge that will also take time. I mentioned integration of systems, integration of best practices as well. So different drivers will also be bottlenecks.
Very good. Anyone else? Everyone agree?
I would agree with Victor. Hybrid system.
Okay.
That's probably, a transition phase to go through.
Very good. Let's go to the next one. So we'll take maybe two more before we rapidly run out of time. This one, I guess, Moody, you can take this. What were the last few weeks like for our cleaning algos, given obviously how much volatility there was?
Oh, I love these questions because I was in the mix in this a few weeks ago. To give you a good understanding, we have different alarms for different purposes, and when the volatility obviously started increasing, we've seen like in our sort of Slack channels, all these alarms were starting to ping, but they were pinging us to say, hey, something's after happening. This is just for you to be alerted. Like the example I gave much earlier, where there was a price discrepancy for a specific curve or many of the same curves, but from different brokers having different prices. So what that allows me to essentially do is to go up, pull up the charts, see the data in real time, and see, is there a problem? And essentially, like, given that you know the markets are busy, Trump is moving it and so on, you can really get a feeling for like how the different providers are reacting. So to give you a good example, like in the distillate market, I saw one provider like essentially being much quicker, like they were on top of the changes, whereas another provider was still like pushing out sort of like a level shift. They were at least $10-20 per ton away. So you can really understand that the market was really shifted away. So what that allows us to do essentially is push through the right data, hold off the other data. But what I really want to say is, without having these sort of systems in place to sort of giving you these alarms and so on, it would be really difficult to understand the volatility in the market. And then on top of that as well, like we have even like sort of more lucrative alarms in that we understand how much messages we're receiving. So you can imagine there's a baseline, and all of a sudden we're receiving like 2 standard deviations away from the baseline. So you know that the markets are much more active than normal. So it sort of helps build the case that the market is volatile. And what we would normally do then is sort of increase our bounds on how much the market can move. So all of these sort of alerts and alarms going off sort of just give us a bigger picture in that we should expect more volatility and sort of relax our alarms and that everything is going fine. But what I would say to sort of conclude is that our cleaning algos are robust. It's great having these systems in place and alarms and so on, but without having them, it would probably be mayhem. So I'm very glad that we have a data team that are focused on sort of providing us these alarms.
Good stuff. And we will have maybe time for 1 or 2 more. There's actually one on fundamentals data. Let's see if I can grab this up. Mark that.
I think this one is for you, Neil.
Yeah.
I guess that goes to me. Hold on a second. Let's see if I can get it
Yes.
on there. In terms of fundamental data, what would you say is the sweet spot in terms of data frequency and ideal total history? Well, I guess the sweet spot is, I mean, you can use fundamental data in lots of different ways. And first of all, you have to assess, what the market really trades upon, and then assess, if you have high frequency data, whether that correlates well to, let's say, what you might call the ground truth. So I always think about this in terms of ground truth. The industry standard for these things are, let's say the ground truth will be something like Jody, which is monthly and obviously several months lagged. And that's not a particularly perfect indicator of everything, because there are revisions even several months after the fact. And after that, you're trying to get closer and closer to the present day in terms of your balances by using high frequency data. But the thing that sometimes falls through the cracks is you have to determine whether that data is useful for predicting Jody, let's say, just taking that example. And a classic one was during COVID. Google and Apple brought out a bunch of mobility data, if you remember all of that. The problem was, for most things, in most countries, it didn't correlate well with Jody demand data, let's say for gasoline or for diesel. So it was kind of a fad, let's say, and the market got very excited about it because suddenly we had hourly and daily data. But actually, it wasn't very ideal for predicting what the ground truth was going to do. And ultimately, I mean, these things got discontinued for the most part anyway, but ultimately it was kind of disproven as a useful data set. So that's the sweet spot is you want to have a high frequency data set that correlates well with the ground truth, which is delayed. So that was a long answer, but I hope it helped, and not very on topic, but I love that kind of thing anyway. And I think let's just leave it there. So we are quickly running out of time. I'd like to thank all of our attendees very much for their participation and engagement today. Thank you also to our wonderful speakers. One of them has disappeared, but we thank him very much for joining us as well. A recording of this webinar will be available shortly. Please check your email and our social media for the link. Also a reminder that we're offering a free 45-day trial of Sparta Curves for a limited time. Reach out to us at sales@spartacommodities.com or visit our website to learn more. Once again, thank you very much and have a great rest of your day.
Thank you very much, Neil.